Hi, my name is Mahesh Machi. My roll number is MB 2205. My subject is corporate valuation, merger and acquisition. And presentation topic is discounted approach to valuation. We are uh, we are going to see all definition, brief explanation, where and when it is used, advantages, limitations, and non-numerical. Let's start with definition. The discounted approach to valuation is based on the principle that the value of an investment is determined by its ability to generate future cash flows or earnings. By discounting these futures amounts, analysts and investors can assess the present worth of the investments, helping them make informed decision about buying, selling, or holding assets. The choice of discount rate is crucial as it reflects the risk associated with the investment. A higher risk typically demands a higher discount rate. Now we will see brief explanation. There are two main methods within the discounted approach: discounted cash flow analysis. DCF is a widely used valuation method that involves estimating the future cash flows generated by an investment and then discounted them back to their present value. The discount rate is used in DCF reflects the time value of money and the risk associated with the investment. It accounts for the idea that a dollar received in the future is not as valuable as a dollar received today. Discounted earnings models. This approach involves discounting the future earnings of a business or investment instead of cash flows. Commonly used earnings metrics include earnings per share or net income. The formula for discounted earnings model is similar to that of DCF, where earnings in each period are discounted back to their present value. Let's see where and when it is used. The discounted approach to valuation, particularly through methods like discounted cash flow analysis, is commonly used in various financial contexts to assess the value of investment, businesses, and assets. Here are some situations where the discounted approach to valuation is frequently applied. First, business valuation in private companies. When valuing private companies that don't have publicly traded stock, the DCF method is often used to estimate their intrinsic value based on expected future value, cash flow. Mergers and acquisition. In mergers and acquisition transactions, both buyers and sellers may use discounted valuation methods to determine a fair price for the business being acquired or sold. Equity valuation. That publicly traded stock. Investors and analysts use DCF analysis to estimate the fair value of publicly traded stocks. This involves forecasting future cash flows or earning and discounting them to arrive at a present value. Project evaluation. In capital budgeting and project management, DCF is used to assess the feasibility and profitability of investment projects. Future cash flow inflows and outflows are discounted to determine the net present value of a project. A real estate valuation. DCF can be applied to assess the value of real estate properties. Cash flows generated by rental income and potential future sales are discounted to determine the present value of the property. Bond valuation. The discounted approach is used to value bonds by discounting the future cash flows, interest payments, and principal payments at the current market interest rate. Startup valuation. For startup companies that may not have a significant operating history, the discounted approach is often used to estimate their value based on future expected cash flows and growth prospects. Insurance industry. In the insurance industry, the discounted approach is applied to value future insurance claims and liabilities, taking into account the time value of money. Dividend discount model, DDM, is a specific form of the discounted approach used to value stocks based on expected future dividends. It is commonly employed for companies that pay regular dividends to shareholders. Bankruptcy and restructuring. In situations where a company is in financial distress or undergoing restructuring, the discounted approach can be used to assess the value of its assets and liabilities. Let's see advantages of discounted approach to valuation. The discounted approach to valuation, particularly through methods like discounted cash flow analysis, offers several advantages, making it a widely used and respected approach in finance. Here are some key advantages. Time value of money. The discounted approach explicitly considers the time value of money, recognizing that dollar received in the future is not worth as much as a dollar received today. This makes the valuation more accurate and realistic. Incorporation of future cash flows. DCF explicitly takes into account the expected future cash flows generated by an investment, business, or asset. This forward-looking perspective is crucial for assessing the intrinsic value of an investment. Flexibility. DCF is a flexible valuation method that can be applied to various types of assets, including stocks, bonds, real estate, and businesses. It can also use in different industries and sectors. Holistic view of business. By focusing on future cash flows, DCF provides a holistic view of businesses' financial performance. This helps investors and investors understand that factor that drive value and identify areas for improvement. Sensitivity analysis. DCF allows for sensitivity analysis, enabling users to assess how changes in key assumptions such as growth rates, discount rates, and terminal values impact the valuation. The sensitivity analysis enhances the robustness of the valuation model. Incorporation of risk. The choice of all discounted is a DCP reflects the risk associated with the investment. A higher risk investment will have a higher discount rate, providing a more accurate representation of the risk return relationship. Long-term perspective. DCF is well suited for valuing assets with a long-term horizon, making it particularly relevant for assessing the value of businesses and investment projects that generate cash flows over an extended period. Objective analysis. The discounted approach relies on objective financial data, such as cash flow, projections, and discount rates. This helps reduce subjectivity in the valuation process compared to methods that rely on market multiples. Considers terminal value. DCF incorporates a terminal value which represents the value of an investment at the end of the projection period. This is especially important when estimating the value of the business or asset with ongoing cash flow generation. Useful for complex financial structures. DCF is capable of handling complex financial structures such as investment with irregular cash flows or very growth rates. This flexibility makes it applicable to a wide range of financial instruments. Now let's move to limitation of discounted approach to valuation. While the discounted approach to valuation, particularly through methods like a discounted cash flow analysis, offers several advantages, it also comes with certain limitations. Understanding this limitation is crucial for using the approach appropriately and interpreting the results. Its results. Here are some key limitations. Sensitivity to assumptions. DCF analysis heavily depends on various assumptions, including future cash flow projections, discount rates, and terminal values. Small changes in these assumptions can significantly impact the valuation results. Forecasting challenges. Accurate forecasting of the future cash flow is challenging, especially for businesses with uncertain or unpredictable income streams. Errors in projection can lead to unreliable valuation. Difficulty in estimating the discount rate. Selecting an appropriate discount rate which reflects the risk associated with the investment can be subjective and challenging. Small changes in the discount rate can have a substantial impact on the valuation. Terminal value assumptions. The calculation of terminal value representing the value at the end of the projection period involves assumptions about perpetual growth rates and when to apply the terminal value. These assumptions can introduce additional uncertainty. Lack of consideration for market sentiment. DCPF does not explicitly incorporate market sentiment. Investor physically, psychology, or microeconomic factors that can influence asset prices in the short term. As a result, it may not fully capture market dynamics. Neglect of non-financial factors. DCF focuses primarily on financial metrics and may not account for non-financial factors that can impact the value of an instrument, such as management quality, industry trends, and competitive dynamics. Vulnerability to manipulation. The flexibility of DCF model can make them susceptible to manipulation. Scrupulous individuals may tweak assumptions to arrive at a desired valuation, leading to misleading results. Difficulty in valuing unique assets. Valuing assets with unique characteristics such as patents, brand value, or proprietary technology can be challenging using DCF. The method may not fully capture the intangible aspects of such assets. Short-term focus. DCF is inherently a long-term valuation method, and it may not be well suited for assets or investment with a focus on short-term returns. It may undervalue assets to generate significant short-term cash flows. Market dynamics. DCF assumes that markets are efficient and that asset prices reflects all available information. In reality, markets can be inefficient, and prices may be influenced by factors beyond fundamental analysis. No consideration of strategic options. DCF tends to provide a single point estimate of value and may not account for strategic options or flexibility that could impact the future cash flows or of a business. Now you can see the discounted cash flow method through this formula. DCF discounted cash flow method involves forecasting the future cash flow of business and discounting it at present value. The formula is look like below. CF1, the cash flow for year 1, year 2, for additional year, and R stand for discounted. And that's it. That's it for my presentation. Thank you. Thank you so much.